Hey, my name is Dan Peterson with Mortgage Solutions LP, and I'm here today to talk to you guys about what it actually takes to get into a home. It seems really simple on the surface, right? We all pay rent every month if you're in an apartment, but getting into a home is a little bit different, right? You need some additional things to actually make that purchase happen. What's the most important thing, right, when you're looking to buy a home? The down payment, right? That lump sum of cash that you need to actually put down at the closing table to actually fund your mortgage and get the keys. There's a common misconception that you need 20% down to get into a home. That's what your parents might be telling you because that's what they used to have to do. After 2008, when the whole crisis happened, that's what every bank started having people do, a minimum of 20 or 30% down back in 2009, 2010. But it's a very, very common misconception. There are a lot of ways to get into a home now with very little money out of pocket. Now, I'm going to talk today about just standard down payments. I'm not going to talk about down payment assistance. I'm not going to talk about grants from the government, things like that. Those are totally different. Those are for another video and another day. But today I'm going to talk to you just about what a down payment can look like in terms of a percentage and what that means for your monthly payment and what it's actually going to cost you over time. Now, if you're a first-time home buyer and you've got good credit, and good I'm going to classify as anything over 680 to 700 and up, you're probably eligible to qualify for as little as 3% down on your purchase, which seems crazy, right? 3% down. I mean, if you're buying a $400,000 house, that's only $12,000. It's crazy, right? But yes, you can actually do it. If you've got good credit, you can get into a house with 3% down, and the interest rate's probably going to be very similar to what you get if you were going to put 20% down. Now, that probably doesn't make sense to some of you either, but the main difference with making a smaller down payment is not really the interest rate. It's something called private mortgage insurance, or PMI. And the smaller down payment you make, the more expensive it's going to be. What it is, in essence, is insurance for the bank to protect them in case something goes wrong or you eventually default on your mortgage down the road. And PMI always becomes a part of your mortgage when you put less than 20% down on your home. So if you put a 3% down payment, you're going to have mortgage insurance that's slightly more expensive than putting 5% down. 5% down is going to be slightly more expensive than putting down 10, and so on, all the way up to 20%. The other important thing to note about mortgage insurance in relation to your down payment is over time, inevitably, as you build equity and gain additional value in your home, and your home hopefully appreciates over time, you're going to reach a point where eventually you have that 20% equity in the home, whether it's through refinancing, whether it's through living in a really hot market like Austin, Texas. What happens when you hit that 20% equity point is that private mortgage insurance goes away, at least on a conventional loan, not a government loan, but on a conventional loan, it'll go away. And it'll go away pretty much on its own. You may have to request it, but it's kind of nice knowing that even if you have to put a little bit down to get into that home, you're not stuck with that additional payment for the life of the loan. Thanks so much for watching. If you'd like to learn more about how to get the best mortgage experience in Texas, check out my website at danpetersonmortgage.com or send me an email at dan@mortgagesolutionslp.com.